Okay, so imagine a company so powerful, so admired, that it's named America's Most Innovative for 6 years in a row. A total giant of industry worth $70 billion. Now, what if I told you it all just vanished in 24 days? This isn't some plot from a thriller movie. This is the real story of Enron. And let me tell you, it's a wild tale of ambition so huge, it basically created a corporate black hole that changed the rules of business forever. I mean, it just sounds impossible, right? It's a riddle. But that is exactly what happened. In less than a month, a symbol of American success, a company that seemed completely invincible, just evaporated. How on earth is that even possible? Well, that's the puzzle we're going to solve today.
To really understand the fall, you have to understand the view from the absolute top. It's the year 2000, the dot-com boom is roaring, the economy feels unstoppable, and down in Houston, there's this futuristic skyscraper, the headquarters of an energy company that has turned itself into something so much bigger. And that company is Enron.
And look, this wasn't some fluke. For 6 straight years, the most respected business magazine in the country looked at Enron and basically said, that is the future of business. On the outside, they were the smartest guys in the room, the pioneers of a whole new economy. But inside, it was a brutal, high-pressure culture. You were either a superstar or you were gone. Simple as that. And this is the number that built the legend. In the year 2000, Enron claimed it had revenues of over $100 billion. To give you some perspective, that made them the 7th largest company in the entire United States. They weren't just playing with gas and electricity anymore. They were making markets in everything you can imagine. Broadband internet, even weather futures. They seemed absolutely untouchable. So with all that hype and all those insane revenues, Wall Street was completely smitten. I mean, investors, from these massive hedge funds all the way to ordinary employees putting away for their retirement, were just pouring money into Enron stock. And the price, it just kept going up and up and up, rocketing past $90 a share. It felt like the safest bet you could make, a one-way ticket to getting rich. So you have to ask, how did they do it? How are they posting these jaw-dropping numbers, this consistent growth quarter after quarter? Well, Enron said it had a secret recipe, a kind of financial formula built on 2 revolutionary tools that were supposedly light years ahead of everybody else. Okay, so the first ingredient was this radical idea from their CEO, Jeff Skilling, called mark-to-market accounting. Now, here's how it worked, and it's kind of wild. Let's say Enron signed a 20-year deal to supply power to some city. They didn't have to wait for the money to actually roll in over those 20 years. Nope. They could estimate the total profit from the entire deal and book all of it as revenue on day one. It was basically a license to print profits out of thin air. And on paper, it looked like a stroke of pure genius. The second ingredient came from their brilliant and very ambitious Chief Financial Officer, Andrew Fastow. He mastered the use of something called Special Purpose Entities, or SPEs. Just think of them as little spin-off companies. If Enron had a risky project or some asset that was drowning in debt, they could just sell it to one of these SPEs. And then, like magic, the debt would just vanish from Enron's books, making the company look incredibly healthy and profitable. But, even at the peak of all this hype, a few people started to notice that something felt off. The numbers were just too perfect. When some skeptical analysts tried to actually dig into Enron's financial statements, they couldn't make any sense of them. It was like a black box. So naturally, they started asking some tough questions. And this was the kind of answer they got on a recorded conference call when an analyst had the nerve to ask why Enron was the only company that couldn't provide a simple balance sheet with its earnings report. CEO Jeff Skilling shot back with that. It was just a stunning moment of pure arrogance, but it was also a warning shot. It was a clear message. Don't look too closely at how the sausage is made. So what were they so desperate to hide? Well, here's the terrifying truth. That mark-to-market accounting was creating enormous profits on paper, but the company was bleeding actual cash. They were booking billions in future revenue, but they didn't have the real money to pay their bills today. The whole operation was basically a ghost, running on fumes and a constant stream of new investor money. And this is where the story goes from a business story to a full-blown corporate thriller. Because that secret recipe, it wasn't just aggressive accounting. It was a meticulously designed system to commit fraud on a scale nobody had ever seen before. Those clever financial tools weren't for innovation, they were weapons. Here's exactly how the con worked. Remember those SPEs? Andrew Fastow wasn't just using them, he was secretly running them. He created these partnerships, which he shamelessly named LJM after his wife and kids, and somehow got Enron's board to approve this massive conflict of interest. So Enron would sell its failing projects and bad debt to these partnerships, hiding billions in losses. And all the while, Fastow himself was skimming tens of millions of dollars right off the top for his services. It was an entire house of cards built on a foundation of pure lies. For a while, the illusion actually held. As long as Enron's stock price kept climbing, those partnerships could use the stock as collateral, and the whole machine kept chugging along. But then, in the fall of 2001, the market started to cool off. The stock price began to slip, and once that happened, the entire fraudulent structure began to groan under its own weight, getting ready to collapse with terrifying speed.
And it all came apart with breathtaking speed. October 16th, the first bombshell drops, a surprise quarterly loss of over $600 million. Just 6 days later, the SEC announces it's opening a formal investigation. By early November, the truth just comes pouring out. The company finally admits its profits were a complete fantasy. A rival company tries to swoop in with a rescue deal, but they back out when they see the true scale of the rot. And then, December 2nd, it's over. Enron files for bankruptcy.
From over $90 a share down to just 61 cents. In just a matter of weeks, all the wealth, all the prestige, the whole illusion of innovation, all of it gone. The darling of Wall Street had become a penny stock. An entire corporation just functionally erased. This was the size of the crater Enron left behind. With over $63 billion in assets, it was, at that point, the largest corporate bankruptcy in the history of the United States. A symbol of American ingenuity had become the new poster child for American greed. But the collapse of Enron wasn't just a business story about mind-boggling numbers. The fallout was immediate, and it was deeply human. For tens of thousands of people, this wasn't just some headline. This was a life-altering catastrophe that happened in the blink of an eye. Over 20,000 employees lost their jobs just weeks before Christmas. And what's worse, many of them had their entire life savings, their 401ks, tied up in Enron stock because they were encouraged to by the very same executives who were secretly dumping their own shares. Tragically, the pressure became too much for some. Vice Chairman Cliff Baxter, who had actually argued against those shady partnerships, took his own life as the company imploded. The scandal was so toxic, it even took down its auditor, Arthur Andersen, one of the biggest accounting firms in the world. They were found guilty of obstruction of justice and just ceased to exist. So the architects of this whole mess, they did face a reckoning. Andrew Fastow, the CFO, he cooperated with prosecutors and served his time. Jeff Skilling, the CEO and the mastermind behind Mark-to-Market, was sentenced to 24 years in prison. And the chairman, Kenneth Lay, the company's patriarch, he was convicted on 10 counts, but died of a heart attack before he could even be sentenced. The smartest guys in the room were finally exposed for what they were: criminals. The shockwave from this collapse was so massive that it forced Washington to act. It was painfully clear that the rules governing corporate America were broken, and something radical had to be done to make sure a disaster on this scale could never, ever happen again. And the result was this: the Sarbanes-Oxley Act, or as most people call it, SOX. It was named for its bipartisan sponsors in Congress, and it was a truly landmark piece of legislation. It didn't just tweak the rules, it completely overhauled corporate governance and accountability in the United States. You see, the law was designed like a surgical strike, with each new rule targeting a specific failure at Enron. SOX created a new board to police the accounting industry, so firms like Arthur Andersen couldn't be so easily corrupted. It forced CEOs and CFOs to personally sign off on their financial reports, making them criminally liable for any fraud. And it made destroying records like Arthur Andersen did a serious federal crime. Basically, every loophole Enron had exploited was systematically slammed shut. And that really brings us to the big question Enron leaves us with. This story is a masterclass in how innovation can be used as a cover for fraud, and how quickly ambition can sour into just pure arrogance. Sure, new laws were written and new safeguards were put in place, but can you really legislate ethics? Can any set of rules truly stop the kind of corporate greed that brought a $70 billion giant to its knees in just 24 days? Now is something worth thinking about.